Assalamu alaikum wa rahmatullahi wa barakatuh. Alhamdulillah. Today we are going to, inshallah, start the third episode of Back to Basics, Season 1, an educational series brought to you by Ethis. Ethis is an Islamic fintech company and operator of several Islamic crowdfunding platforms across Malaysia and Indonesia and a few other countries, alhamdulillah. So with those sessions, we aim to create awareness of Islamic finance in general. So today, inshallah, we're going to proceed with what we have been discussing the last few weeks, last couple of weeks. So again, I welcome all of you, whoever joining this session from Malaysia, from anywhere, any other parts of the world. Thank you for joining the session. And hopefully you have joined the previous sessions as well. If you have missed any of those, you can find the video links in our Facebook and LinkedIn social media pages, as well as if you have already registered, you should have received the links as well. Okay, so without further ado, let's proceed with the session today. Myself, Yousuf Sultan, inshallah, I will be here as a host with you today, inshallah. So if you recall, last week we discussed about sale contracts. And before that, we discussed about the basics of Islamic finance, the underlying theoretical basics. For example, what is Sharia? What are the requirements of Islamic finance? What are the sources of Sharia? What is riba? What is gharar? What is qimar? And all those concepts we try to go through in a very layman way, so that it's easy to understand and grasp, and we can appreciate the value addition of Islamic finance. In the last session, we discussed about sale contracts. So when we discussed about sale contracts, we actually discussed about the basics of Islamic law of contract. So what are the things required for the aqidah, and aqidah meaning the two contractual parties? How should be an aqd and offer and acceptance be concluded? How would be the session? And then if it's a sale contract, what are the requirements for a subject matter? How would be the price defined? So those things we tried to cover in the last session. And we took one sale contract as an example, which was murabaha, which is one of the most widely used sale contract when it comes to the modern Islamic financial institutions. There are many other sale contracts, for example, salam, istisna. Then there are general sale contracts as well, but we didn't have time to discuss those. Hopefully, inshallah, if you express your interest, we will continue in the next seasons, inshallah. Right, so today, inshallah, we will be having a glimpse of the basics of equity-based contracts. So if you recall last session or the last week, we had this chart in our session in the beginning, and we saw that there are multiple contracts which are based on sales, and we only took murabaha as I just mentioned. And then the next part is equity-based or profit-sharing principles, which are mudaraba and musharraka. So today we will be discussing this part, inshallah. Now, when it comes to equity-based contracts, as the term suggests, there will be an equity, there will be a stake in the business itself, in a venture itself, and that will be shared between the parties. So a profit will be shared, the loss will be shared as well. Now, when we look at the equity-based contracts, the two prominent terms come into the picture, which are musharraka and mudaraba. The diminishing musharraka that we see in this screen is basically, we can say, like a new denomination of musharraka, which also includes some subsequent contracts. So it starts with musharraka, but there is an ijara, there is a sale. So we'll not be discussing that in this season. We will be going through the very underlying principles of a musharraka partnership contract, so that we can appreciate the requirements. Why are those requirements in the first place? then how we can adhere to and how we can structure the complex Musharraka or equity-based structures based on those. Okay, so let's start with Musharraka. Now, Musharraka is an Arabic term like Murabaha as well. Yes, last week we discussed Murabaha. Those are Arabic terms. What Musharraka means is basically a partnership. Now, how it will work is basically an agreement. There should be an agreement between two or more parties, meaning that there will be an offer, there will be an acceptance, as we discussed last week. Now, is the purpose of the agreement? Either to merge their assets or combine their services or combine their obligations and liabilities with the aim of making profit. Now, this is basically a definition of one type of musharaka. In the next slide, we will see there are, in principle, in the very basic point of view, there are two main types of musharaka. So this is basically the one which is concluded to generate profit, to make profit. You see the second definition is basically the other one which I mentioned. So as an equity partnership or a joint enterprise whereby the parties share in both profit and loss. So this one is a bit more general than the first one. How? Let me go to the next slide, next few slides, and we can know, inshallah. Now, related to this, I also brought here mudaraba. Now, mudaraba, even though we know it as a separate instrument, but traditionally, or if we go through the fiqh books, mudaraba is actually one type of musharaka. Actually, in the classic fiqh books, they don't mention musharaka. They mention shirika or sharika. They don't mention mudaraba in most fiqh books or in most fiqh schools. Rather, they would mention qirad, muqarada. So they are all basically synonyms. But mudaraba, as I mentioned, is a part or is a type of musharaka. How it works is that in a musharaka, in a musharaka partnership, two parties or more than two parties, everyone gives some sort of capital. So either it could be capital of monetary capital, it could be in-kind capital, it could be liabilities, it could be obligations. We will see inside, inshallah, in the next few slides. However, in mudaraba, there are basically two parties. Now, one party will inject the capital, the other party will be managing it. So that's the basic difference between a mudaraba and a musharaka. So as you see in the definition, this is basically a definition by Ayofi. It's a partnership in profit whereby one party provides the capital. They will be called Rabbul Mal. Rabbul Mal, Mal means wealth. Rabb means the owner. It can be, there are a few other meanings, but here is basically the owner of the capital or the wealth. And the other party provides the labor, the management. Now, you might know that our beloved Prophet Muhammad sallallahu alaihi wasallam, even before marriage, he used to do mudaraba business or mudaraba partnership business with Ummul Mu'mineen Khadija radiallahu anha's properties. So this is where Ummul Mu'mineen Khadija radiallahu anha came to know about the trustworthiness, about the efficiency, about the business mindset of Prophet Muhammad sallallahu alaihi wasallam. So he used to do mudaraba business. And then there are other examples as well from the life of Prophet Muhammad sallallahu alaihi wasallam, and also the Salaf Salihin and the companions. Now, why mudaraba is into the picture? Because there are situations when a party has expertise, but he doesn't have money. He needs funding from someone else. And then there are parties who have funds, but who doesn't have expertise to manage a business. Now, to bridge a gap between the two parties is where mudaraba comes in. One of my professor, he used to say, like, he is an economist historian. He used to say that mudaraba, the concept of mudaraba, is the one that was renamed or known as commenda in the West at some point of time in the history. And today's venture capital is basically one of the variants of it. So if you look at the venture capital funding, if you look at what's happening in Silicon Valley, for example, we will see it matches a lot with mudaraba. So one party who is the entrepreneur, they have ideas, they have projects, they have businesses and expertise. They need funding, then the other party comes with the funding. And they both, share in the profit as well as the loss. So if the business grows, there is a profit for both parties. If the business doesn't grow, it becomes liquidated or there is a loss, then the capital provider loses his capital, and the manager of the fund or the entrepreneur loses his labor, basically the time and energy he has given to the business. Anyway, let's proceed. As I mentioned, Musharraka is where both parties will contribute the capital. Mudaraba is where one party will contribute the capital, not the other party. Now let's look at the very basic types of Musharraka. Now Musharraka, as I mentioned, primarily is of two types. One is a joint ownership, meaning that two parties or more than two parties jointly own an asset or a property or something else, not necessarily for profit, not necessarily by a contract. So what I mean by not necessarily by a profit, so meaning that let's say two person together, they purchased a land, for example, for their own use. They will reside in the land, for example. It's not for business, it's not for making profit. So it's a musharaka as well, it's a joint ownership. Similarly, maybe two parties or two persons own a wealth, a shared property, but not through a contract, but just because they inherited from their father or for someone else who died, and as heirs recognized by Sharia, they inherited the property together. So they have joint ownership in the wealth, but it's not by contract. It's not for the purpose of making profit. So this is Shirkatul Milk or Sharikatul Milk. Then we have Shirkatul Act or Sharikatul Act, which is basically act is contract, which is a partnership through contract or by contract. Why? To make profit. Now this one, we have two types, which is traditional and modern. Traditionally, in the books of fiqh, they discuss, the fuqaha, the jurists discuss three types of Sharikatul Act. One is Sharikatul Ainan. Usually this will be through Sharikatul Amwal, meaning that the two parties will be having a contractual partnership and they will inject capital or mal or wealth as or assets as the capital of the partnership. The second one is Sharika al-Wujuh. There is a typo here, I'm sorry for that. The last one is Shirkat, not Shikra, sorry. Shirkatul Wujuh, which is basically liability partnership. What it means is Wujuh means face, Wajhun means face. So people, by their face value, they can purchase things on debt. They can purchase things on deferred payments. So let's say 2% come together and say, okay, I have some face value, meaning I know people, I have networks and connections. I will buy certain products on debt and you will buy certain products on debt. Now the liability among us is 50-50, meaning that if something goes wrong, then I have to pay 50% of whatever debt we incur and you will have to pay the rest 50%. So the capital here is basically the liability. So they are taking responsibility or liability of paying 50%. So based on that, the profit will be automatically 50-50 as well. So the person who is taking 50% liability will also get a right of 50% profit as well. Sharika al-Amal or Shirkatul Amal is basically a vocational partnership. So let's say two-person, they both are engineers or both are software engineers, or let's say they can create websites or mobile applications. So they come together and they say, okay, we both will, contract with the customers and clients, and we will take freelance contracts or outsourcing contracts, and we will work together. So there is no capital injected. The work they do will be shared together, and that's what will make revenues. So it is a bit similar with Sharikatul Wujuh in the sense that the liability they take will be the basis of the profit sharing ratio. So if they say, okay, if I'm taking 50% and you are taking 50%, so the profit sharing ratio will also be 50-50. Anyway, so those are the three types of classical musharaka or traditional musharaka we notice in the books of fiqh. If we look at the modern musharaka applications, we see the stock companies, joint liability companies, or partnerships limited by shares, And even diminishing Musharraka, which I mentioned, is basically a combination of several contracts which are executed in sequence through banks and financial institutions. So stock companies, if we look at, which are basically limited companies, these are registered as an independent entity. The founders or shareholders here are also like Musharraka partners. So the traditional hukum or the rulings that we have for partners in Musharraka will also be applicable in the stock companies or newer forms of Musharraka partnerships. Now let's see, go through a very basic process flow of Musharraka. So in the step one, the two partners come together and sign an agreement. This is where the offer and acceptance come across. And what will they have in the agreement? The very basic one is they will say, okay, this is the capital we are putting, and I'm putting, and this is the capital you are putting. And second thing is to determine the profit sharing ratio. What it means is that in Musharraka and partnership, basically they are partnering in the business and taking share of the profit as well as the loss. Now, loss always follows the capital ratio, the proportion of the capital injected. So if someone has invested 50% of the capital, he will have to bear a loss of 50%. So that cannot be changed, that cannot be mutually agreed upon. That is something separate. But for profit sharing ratio, we will have next slide, inshallah, to explain more. But in general, profit sharing ratio can be agreed upon different than the capital ratio, meaning that let's say someone has invested 50% capital, but maybe his profit sharing ratio is below 50%, maybe 40%, maybe 30%, maybe the other person is getting more. We will inshallah discuss about the details of the profit sharing methodologies, but these are the basic components of the Musharraka agreement. Now they can further put some other clauses like, okay, this is the business we are going to do. What are the roles of the Musharraka partners? Who will be managing it? Those are the additional things they can put in the agreement. But without those, still the Musharraka will be valid if they have the basic clauses. Then in number two is basically they will put in their capital. So this is where the investment comes in. I think it's a bit wrong, the symbolization. I'm sorry for that. So basically these two are showing that the capital is flowing from the two partners. And finally, when there is a profit and loss, the venture distributes the profit and loss to the partners based on the profit sharing ratio. If there is a profit, if there is a loss, then it will be according to the capital ratio, as I mentioned. We will discuss now, inshallah. Now let's go through some basic requirements. So let's say Musharraka capital. What are the requirements? It can be in monetary assets. It can be like cash, for example, dollars, pounds, or whatever currencies. It can be also in kind. Let's say someone has given his property as a capital in Musharraka, or maybe his, some real estate or some mobile property, whatever, as an in, or any other asset as an in-kind capital. It's fine, but the requirement is it has to be valued and converted into a currency. So when we have the ledger for the capital, we cannot have that, okay, partner A has invested $500,000, partner B has invested property. Cannot. That property has to be valued and converted into the single currency. We will see the next point is single currency. It has to be in single currency. So let's say the capital is, each party is giving a different currency, but the Musharraka should have one single currency. Why? Because the capital, if it is different currency, then often because of the FX rate differences, foreign exchange rate differences, the ultimate capital value could be different. And it will be when there is a dispute and there is a loss, for example, and we need to distribute the loss. As I mentioned, the loss is strictly distributed or borne based on capital ratio. We will not be able to do that because the capital ratio is not determined. It's not firmed up. So that's why we need to convert into a single currency, right? And it's better to have the same currency that is the Musharraka business is being operated in. If not, it's still fine as long as the whole Musharraka has one single currency is fine. Why? Because if it is not in the business currency, so maybe let's say you have a currency of the business in a country where the FX has a lot of variations within a small amount of time. So maybe when you are investing in that in that country, maybe the currency of the capital currency is different and the business currency is different. So we say, okay, Musharraka is based on, let's say, US dollar, okay, but the business currency is different. So the profit, the loss, the revenue, that every other calculation is based on a different currency. So maybe in that currency there is a profit, but when you convert on the spot rate based on the spot rate to the primary currency, maybe it becomes a loss. So it becomes very, very difficult. So it's suggested, it's recommended to have one single currency across the Musharraka. But at least in the minimum requirement is that the capital should be converted into one single currency, so it's easily understood and we know the ratio of each partner. Receivable can be a Musharraka capital? No. Let's say someone owes me some money and I say, okay, since you owe me some money, and you are starting this business, consider the money you owe to me as a capital in this business. It's not valid. Yes, if the receivable is part of the capital, in other words, receivable is not the primary capital, rather it's a secondary one. For example, someone is investing cash, but there are some receivable, then it could be considered. But in general, if the whole amount is receivable, it will not be a valid capital. Why is that? Because end of the day, the purpose of investing a capital is to make it available so that the business can invest it, business can use it and generate profit. The ma'qud alay, or the subject matter of Musharraka and Mudaraba contracts, is to make profit. The profitability is the subject matter. Now, if the capital is not available at the disposal of the managing partner or the Mudarib, then he will not be able to generate profit from it. So the primary purpose is no longer there. So that's why receivable alone cannot be the capital. And capital should be always well determined. Why is that? Because as I mentioned, when there is a loss, it will be strictly borne based on capital ratio. So if we don't know who invested how much and the capital is not properly ledgered, then it will be a problem when there is a dispute. In terms of management, the parties, by default, everyone can participate in the management. However, they can also choose some people, a single person, to be the manager. Now, the manager, who is basically a partner in Musharraka, by default cannot take any lump sum money as his salary or service fee or whatever. Why is that? Because as a partner, one is basically participating with his funds and sharing in the profit and the loss. Now, if we give certain partner a certain amount of lump sum, let's say we give someone $10,000, regardless of the business making profit or loss, then in essence, it's actually depriving the other partners from potential profit, or maybe from the profit at all, I mean, completely. So because of this reason, no partner can have a lump sum as based on as a profit or as a salary or whatever. In the next slide, we will have much more clarification, inshallah. But for the purpose of this slide, if there is a manager, he is also a partner and he is providing more time. So what can we do for him? We can increase his profit sharing ratio. Let's say he have contributed 50% capital, but he is also working. He's a working partner. He's not a sleeping partner. We can give him 70%, 80%, 90%, 99% profit as well. As long as the other party is not completely eliminated from the profit, it's fine. We will have more clarification in the next slides, inshallah. But let's say the manager is still wants or insists, or the company or the shareholders, they still want to give him salary, pay him salary. So in that case, the way out is there will be a separate contract, employment contract, just like any other employment contract done with any other employees. And under that employment contract, it will be specifically mentioned the services that he will be providing or the roles he will be playing, and then how much salary he will get. So basically the two roles will be separate. On the role of a partner, he is not getting any fixed amount, but on the role of a employee, he is getting a fixed salary. Now those are completely separate and unconditional from each other, meaning that if for some reason he is no longer providing his services or no longer a salaried person, his partnership still remains. Or if the partnership liquidates, he still remains as an employee. So the two contracts are not interlinked and not conditional to each other. Then it's valid. Or even the Musharraka partners can also appoint someone else who is not a partner to provide the services as a manager. And if he is a third party, meaning he is not a partner, definitely he can get fixed salary, no issue on that. Now, what are the things that a manager is allowed to do? In principle, anything that does not go against the general business practices of that particular business, he is allowed to do. Right? So a manager or a managing partner is basically like a wakil and an amin, like a trustee and an agent of other partners. An agent or a trustee should always work at the best interest of his principal, of his beneficiary of the trust. So in other words, every partner who is also a managing partner or a manager should always work at the best interest of the business. But if he is to give loans, for example, from the business, or to give some grants, or to purchase something at a excessive higher price, or selling something at excessive lower price, then he has to obtain explicit permission from the shareholders, because this is something he is not given permission by default. This has to be taken explicit permission for. So this is all about the management. Now, guarantees. Can a partner guarantee the capital or profit of the other partner? No, because a musharaka is a sharika, or is a partnership in profit and loss. If there is a profit, they share the profit. If there is a loss, they share the loss. Now, one party cannot say, and they cannot even mutually agree upon that, okay, I will bear all the loss. You don't have to bear. You cannot. The moment one partner is guaranteeing the capital or the profit of the other partner, it immediately turns into a loan, because a loan is what guaranteed. A capital is guaranteed in a loan. There is no other such cash forward whereby the capital is guaranteed other than a loan. Now, if it's a loan, then any excess given on top of loan based on contractual agreement is riba. And riba is what prohibited, what we discussed in the very first session in detail, right? So we want to avoid that, and this is why we want to do musharaka, mudaraba, or various other Islamic contracts. So hence we cannot have a guarantee from any of the partners. Now, what if the loss is because of the negligence or the misconduct or a breach of contract by the managing partner? If that is the case, then yes, he will have to bear the consequences of his decisions, or the loss that was a consequence of his misconduct or negligence. So for example, the contract says that he cannot do business of, let's say, mobile phones, but he did a business of mobile phones. He purchased mobile phones and made a loss. So that's a breach of contract, and that will be considered a negligence on his behalf or a breach of contract, and you will have to bear the loss, meaning that he will have to top up the capital that was lost. Now, bearing the loss doesn't mean that he will have to give the profit, because giving profit is far away. There is already a loss. Now, he will only have to bear up to the capital loss that he was responsible for, not the one that he wasn't responsible for. Okay. Now, there is a provision that a third party who has no contractual relationship, no financial liability or no legal capacity with any of the partner, he can provide a guarantee. One more condition is that third party cannot be owned, or the partners cannot own that third party by 50% or more. In other words, there shouldn't be any ownership relationship between the partners and the third party guarantor. A prominent example of this is the central banks, for example. The central banks often guarantee a certain portion of the deposits made by the depositors in an Islamic financial institution. So since the central bank is a third party, it doesn't have a contractual relationship with the bank or the depositors, it is fine. Other than that, one party cannot provide any guarantee to the other party. Okay, now the most interesting part in a Musharraka or Mudaraba contract. It's all about profit mechanism, how we determine and distribute profits. Now, first, we have to understand and acknowledge what is profit. Profit is basically all revenue earned from the business through a certain period of time, minus all direct or related expenses. Now, what does it mean? It means that a revenue itself is not a profit. Revenue before deducting the expenses is not profit. Revenue after deducting unrelated indirect expenses is also not a profit. It's actually further deducted. So an example of a direct and indirect expense, let's say a Islamic financial institution which has multiple types of operations. It conducts transfer of funds, maybe LC, maybe Mudaraba, investment, and many other things. So it has some utility cost, some rental for its office premises and this and that. So can it deduct the utility and rental of the whole premise from the Mudaraba and Musharraka fund? Cannot. It has to compute a relative or expense for this particular Mudaraba and Musharraka. So if there is 10 Mudaraba with the varying sizes, maybe it can distribute the cost among the Mudarabas based on the Mudaraba fund size. It can do that. One more direct expense would be the direct expenses. More example about direct expenses would be, let's say, for the Mudaraba business itself, there needed a warehouse, some transportation was required, maybe some specific people were to be employed. So all those who were directly involved with the Mudaraba business will be considered direct expense of the Mudaraba. So we deduct all those expenses, even tax as well, and then we get the profit. So why is this important? Because in some cases, in some countries, we hear that there is a revenue sharing. Now, revenue sharing is problematic, and IOFI hasn't allowed as well. And this is the view of the majority Sharia scholars, as we know. Why? Because when we share, let's say we share when there is a revenue, let's say a revenue of $100,000. So we share the revenues. Okay, so we say, okay, 50-50. So you get 50,000 and I get 50,000. So after we distribute the 50,000, then there is an expense. Who will bear the expense? So definitely one party, usually the managing party, would have to take the expenses. Maybe the expenses are even more than what he got. Maybe the expenses are $70,000, $80,000, even $100,000. So what's happening is that in the least case, least worst case, one party is getting eliminated from the entire profit, and the other party is basically enjoying profit. Now, this is a zulm. This is an oppression in this Mudaraba or Musharraka contract, which Sharia wants to eliminate. In the very first session, we said one of the objective of Sharia in this whole fiqhul muamala is to achieve justice. So we cannot say, okay, you get share from the revenue before we deduct expense, and all this expense is on myself or someone else. We cannot say that. It's a zulm. Even though people are agreeing to that, it's still not fine. So what we can agree upon is a ratio or a share of the profit, and profit is revenue after deducting all the expenses which are direct and related. So the requirement is this profit sharing ratio, or the PSR, should be determined at the inception of the Musharraka or the Mudaraba contract. If it wasn't determined, at least before a profit is actualized, before it is time that we can distribute profit. Why is it important? Because if we don't determine that time, if we don't determine at the inception, Then when it is time for distributing profit, there will be definitely dispute. And this dispute is what Sharia wants to, remove. So that's why we need to have understandings clear before even any financial obligations are created. Okay, now what do we mean by profit sharing ratio? What we mean is that a percentage of profit can be determined. We can say, okay, party one will be having 20% profit, 20% of the profit. We cannot say 20% of the capital, or we cannot say $20,000, for example. Because if we say 20% of the capital, let's say we say 10% of the capital, and the capital is $100,000. So if we say 10% of 100,000 is still 10,000, or we can say 10,000. Both are basically same. What we are doing here is basically specifying or defining a lump sum, a specific amount. Now, why is this problematic? Again, as I mentioned, if we give 10,000 to someone, and maybe the profit is not 10,000 at all, or maybe the profit is below 10,000, so that only one party is getting the profit, the other party is not getting any share. So that's why we cannot do that. Now, the general rule of thumb when it comes to any profit sharing mechanism is the last sentence of this slide, that in no circumstance should the profit sharing mechanism result in precluding a partner entirely from participation in profit. Remember that the subject matter of this contract is profit. The parties should have a share in the profit. So we cannot come up with any mechanism which precludes any of the party entirely from the profit. This is the very ground rule we have to remember when we structure a mudaraba or a musharraka contract. Now, some more conditions or some more things about profit. For example, parties can agree on any PSR. So it doesn't necessarily need to be strictly based on capital ratio. It can be different than capital ratio. However, there is one rule. The rule is that the person who is a sleeping partner, right, he cannot have a profit sharing ratio more than his capital contribution ratio. So let's say two parties come to a Musharraka partnership. One is providing $5,000, the other one $5,000. So we know 50-50 is the profit sharing ratio, right? Now, one party is a sleeping partner, the other party is the working partner. The working partner will work on top of the capital he has contributed. Now, we can give him more than 50% profit. Why? Let's say we give him 70%. So in this case, 50% will be because of the wealth or capital he has injected, which is 50%. And the rest 20% will be considered against the labor he is providing, the management task he is doing. A person can get profit, or a person can get a right of profit because of either of the three. Because of the mal, imma bil mal, meaning that he is providing his wealth or as a capital, so he can get profit share because of that, or bil amal, by his work, his labor. So for example, a mudarib, he doesn't provide any capital, but he is providing his labor. So we are giving him a profit sharing ratio as well. Or dhaman, imma bil dhaman. Dhaman is liability. So as we saw in Sharikatul Act, the partnership which is based on face value, as I mentioned, there the parties are basically taking liabilities of the debts, and because of that they can get a portion in the profit. Okay, some more thing. So since we know the ground rule, now we can be innovative, no problem. We can have different variable profit rate, profit sharing ratio. So we can say, okay, in year one, then it will be 50-50, in year two, it will be 40-60, and year three, 70-30, and so on. As long as we don't make 100-0, if we make 99 and 1, is still fine. It's still fine. As long as it also adheres to the first part, whereby a sleeping partner cannot have profit sharing ratio more than his capital ratio. If it adheres to that, then even if it can be 90-10, it can be 99-1, no problem. Furthermore, a ceiling of profit can be also fixed. For example, we say the profit sharing ratio is 50-50, but if profit goes beyond $5,000, then anything addition to $5,000 will belong to party B. Is it okay? Yes, okay. Why? Because let's say the profit is 5,000, then it will be 50-50, right? If it is 7,000, then still the 5,000 will be distributed 50-50, and the additional 2,000 will be given to party B. Meaning that there is no such circumstance whereby we are not giving anything to party A. Party A is always in all cases receiving the ceiling. But if we reverse this formula, that okay, if the profit goes beyond a certain limit, then the other party will have a share. If not, then he will not be having a share. Now, is this valid? No, because let's say the same example that we gave, let's say we say if the profit is beyond 5,000, then both parties will share. If it is below 5,000, then only one party will get. So in this case, if it is below 5,000, then one party is precluded completely from the profit. This is what is impermissible, and we cannot have that. Now, lastly, profit can be distributed based on actual or constructive valuation. What it means? Usually, traditionally, a mudarib or a sharik or partner would be having they used to have musharraka based on certain project. Let's say they used to go to Yemen with trading items. They sold that there, and then they brought goods back to Makkah, Medina. Then they sold here. They made profit. Khalas. Musharraka or mudaraba is liquidated, closed. But now we have companies for hundreds of years. There is a continuation of the businesses. So we don't necessarily need to liquidate to determine the profit. Rather, we can have a constructive valuation. What it means is that we will value the assets of the company and then determine if there is a profit or loss. Based on that, so let's say every year, usually there would be a financial year for companies. So let's say end of the financial year, we do an audit, and based on the audit, we know how much asset is there, how much profit we have made, even though the things are not liquidated, the assets are not liquidated. So that is valid from share point of view, is still valid. Now, the principle of loss is very, very simple. It cannot be tweaked. It cannot be innovative. No creativity can be put here. It's very basic. That it will always be borne based on capital contribution ratio. Now, yes, I mentioned previously as well, if there is a negligence, if there is a misconduct, if there is a breach of contract from the managing partner or the mudarib, then it's a different case. He will have to bear the loss for which he is responsible. Not the entire thing, but for the one he is responsible for. I mean, he did misconduct for. But in general, loss will always be borne based on the capital contribution ratio. So based on this principle, if I ask you, who will bear the loss, how much loss, who will bear how much loss in mudaraba contract? So as you know, as I mentioned, mudaraba is one party gives the capital, the other party gives the labor. So we know that 100% capital is provided by one party. So in general, in a mudaraba, 100% loss is borne by the capital provider or Abdul Mal, unless there is a misconduct or breach of contract on the mudarib's part. In that case, he will be liable for the loss that we discussed. Now, because we see that there is a higher degree of integrity and amana and trust required, we see some practical issues in Musharraka. For example, when we invest with someone in a Musharraka contract or a Mudaraba contract as a partner, so we become partner in the business itself. Now, our income or our return of investment or ROI will depend on the performance of the business itself. Now, if the performance of the business are not properly declared, if there is a lack of integrity, if there is a non-disclosure of bookkeeping, or the bookkeeping is not proper, then there is a risk of determining the profit itself. So we may not know if there is something funny going on, if there is a corruption, or if there is some funds moving without the other partners or the sleeping partners' knowledge. So those are practical issues. There is also a mindset of the customer or the mindset of the partner, fund provider, sorry, the managing partner. He doesn't want to disclose properly. He doesn't want to share the revenues and losses of the business. So this is where we see some practical issues in Musharraka. But in general, Musharraka and Mudaraba partnership contracts are seen as one of the most ideal contracts when it comes to Islamic finance, because the risk sharing element is very, very prominent here. But then we have to handle those contracts with care. We have to choose, the Musharraka, the managing partner or the Mudarib by looking at his past expertise. I would recall here the very famous verse whereby the daughters of Shu'aib alayhi salam, they mentioned about Musa alayhi salam to their father, that in khayra man ista'jarta al-qawiyul amin, that they described Musa alayhi salam as qawi and amin. Qawi is the one who is strong. Is strong in faith, is strong in actions, is strong in mind, physically, psychologically, meaning he is competent. And Amin is trustworthy. So those are the two things we have to always look for, even when we choose a partner, even when we choose an employee or someone we want to work with. So similar case in Musharraka, we have to see if the person has a experience of the business, he has past experience and all those things. And also we have to see if he's a fraud or he is trusted or not. With those two very basic components, we can enter into partnership. But it's not that anyone comes with a Musharraka, we just go and invest money. No, we have to handle with care and do the risk assessment so that we are well aware of the risk that we are taking. But considering all those, if we look at the very nature of those contracts, if we are, we can apply those contracts in a wide scope in our countries, we hope inshallah there will be more value creation and income equality among the mass people. Today we see people put money in the bank, but they don't enjoy the profit that are made by the borrowers. Like people who are borrowing the money from those financial institutions, maybe they are not putting their own funds in the business. They are making profits like 100% or even more. But end of the day, the owners of the funds, maybe they are only getting 2%, 3% or something like that. So with such profit and loss sharing contracts, there is a higher potential to bring income inequality, reduce income inequality and bring more sustainability and to the economy, inshallah. So with that, I think we will end the session today. My presentation today. I see a lot of questions coming on. Inshallah, we'll try to answer. Okay, so the first question we have is it permissible for me to keep my principal and dispose of my interest in a non-Sharia compliant investment linked policy? Okay, keep my principal and dispose of my interest in a non-Sharia compliant investment linked policy. Dispose of my interest. Okay, so the question is basically, okay, what if we invest or we put our money in a Sharia non-compliant instrument or policy which gives interest. However, we keep the capital and we or the principal and give away or dispose of the interest. Now, in general, yes, it is permissible because we are not consuming the riba. But the point of caution is we are still agreeing to riba in some sense. So in countries where we have Islamic financial institutions, this is not recommended because we have Islamic financial institutions. What if on the day of judgment, Allah subhanahu wa ta'ala asks us, why did you have a riba contract when you had an alternative? Would we be able to answer? No. But for countries where we don't have an option, this is a different thing. So scholars of those countries usually would say, okay, it's fine because you don't have any choice. You keep the principal and dispose of the interest. All right. As a financial consultant, next question, is it permissible for me to sell a non-Sharia compliant investment to a Muslim? I have explained the importance of a Sharia compliant investment, but the client chose to purchase something else that involves riba. Will it be sinful for me to proceed to sell the non-Sharia compliant investment? A very important question. Now, what is happening in essence in this case? I am selling or I am promoting to someone a riba, a prohibited thing. It's just like I'm giving someone, okay, this is wine, please take it. So because it's a haram thing, it's a prohibited thing, when I'm making money out of it or I'm selling it, it's also prohibited. Now, the case that I understand from your question is that you are presenting the halal one but the client chooses something that you haven't presented or promoted. If that is the case and you are not earning anything from it, then it will not be a burden on you. It will be a burden on the investor himself. So he will bear the consequences of engaging in this riba. But if you are promoting both and you are earning a commission from this as well, then you have to bear. May Allah subhanahu wa ta'ala protect you and us, all of us. Okay, the next question, is it permissible to invest, or is it permissible to invest in a non-Sharia compliant investment and upon maturity, I only keep the principal and dispose zakat the interest? I think it's the same question. I think you already asked once, but since you brought zakat here, let me answer again. So the haram income, the prohibited income, we cannot benefit from it in any manner. It's not like we can pay zakat through it. No, because haram funds or haram income doesn't belong to me in the first place. So anything that brings benefit to me in this world or the world hereafter, I cannot do with that. Now, when scholars say that you dispose of in sadaqah, they don't mean that you make a sadaqah out of it with an intention for reward. Yes, Allah subhanahu wa ta'ala can give reward to anyone, but in principle, since I do not own that fund in a legitimate way, I'm just kind of throwing it out, but of course in a proper manner, throwing it out in a way that it also benefits the public, benefits some charity or something. But I'm not intending to get reward out of it because it doesn't belong to me in the very first place. But yes, end of the day, it can. Inshallah, Allah subhanahu wa ta'ala may accept it. We hope and make dua for it. Okay, assalamu alaikum. Next question. How can we switch from the existing Musharraka contract to Murabaha contract? In other words, is there any way to transfer Musharraka or profit loss sharing contract to Murabaha or debt-based contract due to some tax and risk management issues? Okay, wa alaikum salam wa rahmatullah. If I understand correctly, you have a Musharraka. Let's say you have a Musharraka on an asset or a Musharraka on whatever, and you want to convert that into Murabaha. Now, what is Murabaha? If you recall, in the last session I have explained, Murabaha is basically selling an asset. So the party who needs the funds, we cannot give him funds because we cannot earn any interest on the funds. So rather, we are selling him an asset on a profit, right? So if we consider that a Musharraka has already been concluded and maybe the asset has already been purchased and the ownership of asset already belongs to the Musharraka, then it's a bit difficult to convert it to Murabaha because it's already concluded. The ownership has already been, properly determined. Now, if we say, okay, it's a Murabaha, meaning that we consider that this asset has not been bought, this has been actually still with the vendor, then actually we are doing a lot of fake things. Na'uzubillah. So if the asset hasn't been purchased yet, so the money is still cash and you just want to close it, void it, this is possible. Musharraka or Mudaraba before starting the business activity can be made void, can be cancelled mutually as mutually agreed upon. That is possible. So once you cancel it, the fund is going back to the capital providers, then you can do other modes of contracts. But if the business has already been engaged on, Musharraka has already been done, I'm afraid it may not be possible, but we still need to see the details. Okay, thank you. I think we have some questions in the chat box as well. Assalamu alaikum, Sheikh. Can you explain how do we determine the PSR for contribution in kind? For example, a partner contribute a trademark into the partnership. Do we do the constructive valuation? Okay. A partner contributes a trademark, right? So trademark, is it a mal or not? Yes, it's a mal. It's a wealth. It's an asset. This has been concluded and deliberated on and decided by the international fiqh bodies. So we consider this as a mal. It's a valid wealth. Now, if someone wants to contribute that as a capital, it has to be valued, meaning that the valuation can be either by a third party or there can be some benchmark, and based on the benchmark, both parties can mutually agree, they can negotiate, and that should be fine. As long as both parties agree that this is the value of the asset, then that value has to be recorded in the single currency as we mentioned. So once that is converted, now we know how much capital he has put. Let's say one party has put $500,000. The other party has given trademark. Now the trademark itself is valued at $500,000. So he is actually putting 50% of the capital. Hence, he has to bond 50% of the loss as well. Hope that answers your question. Next question, Assalamu alaikum. In Mudaraba, if loss is 100% liability of Rabbul Mal, then how Sharia banks doesn't put anything on their clients in case of loss? Because it's difficult to believe every investment by bank is profitable. This is a very good question. Thank you so much. So how banks and formal financial institutions work is that they have several layers of mechanisms to protect against loss. Now, one of those is called PER, or Profit Equalization Reserve. So when there is a profit above the expected ceiling, then they would actually put some of it to this reserve, so that when the profit is below the ceiling, so they can top up. Why they do that? Because usually, like so far, we only had Sudan and Iran as complete, Islamic financial jurisdiction, right? But very recently we came to know that Sudan is also going to dual banking practices. So in other words, like almost all the countries in the world, they practice dual banking, meaning that there is Islamic banks and conventional banks as well in the same jurisdiction. Now, when we compete with the conventional banks, and they have some specific ratio, interest rate or whatever, it is difficult to compete with them in the same jurisdiction for the Islamic bank. So they also try to achieve the same ceiling, however, through Islamic mechanism. So one of the mechanism is, of course, this PER. Another thing they try to do is, of course, the risk management department is doing their job. They would look at the portfolio, of course, diversify the portfolio. And as we know that it rarely happens that all the assets of the portfolio goes to loss. Of course, there are some balances. One last thing they do is that once they get the profit, or once the profits are allocated based on the profit sharing ratio, a party or a partner can do a tanazul, a voluntary tanazul. Tanazul is basically waiving one's own right. So once I'm given a right, I can waive my right. I cannot do that contractually or pre-agreed upon, but without prior agreement or prior contractual rights given, I can voluntarily give my right once the right has been given to me. So this is what the Islamic banks do. Let's say the expected profit rate is 5%, right? So end of the day, the investors were supposed to get around 4% or something. But Islamic banks, what they would do after utilizing other options, as I mentioned, profit equalization ratio, etc., they would do a tanazul, a voluntary tanazul, or waiving of their own right, so that they can top up the 1% for the customers. This is fine as long as it is not pre-agreed upon, as long as it is not promised to the customers that you will get 5% no matter what. Immediately it becomes riba, as we have discussed in detail. But if it is not, if the contract says it's only about profit sharing ratio, but then when it comes to realization of the profits, one party voluntarily gives the other party more than what he is deserving, it is fine from Sharia point of view. Basically, from Sharia point of view, if I am the owner of the right and I am waiving of my right, Sharia would not say anything. This is basically a general rule. But of course, it shouldn't be pre-contractual or pre-agreed upon. Okay, I think I have answered all of the questions that I had in the screen. If there is any other question, you can ask, but I think we have also run, it's just exactly 9 p.m. in Malaysia. So I think we can end the session if there is no other question. Before I finish, again, Musharraka and Mudaraba, if you look at the venture capital funds or other private equity or the startup funding, etc., the funding part almost is similar to the Mudaraba contracts. So it's just that we haven't exercised it properly for centuries when it comes to Muslim countries. This is why we are more comfortable with banks or institutions that give us fixed return, but it's not necessarily the most proper or the best instrument that we have or use. We should try Musharraka and Mudaraba, even though in limited scale, and get used to it. A Muslim by nature would be more investment friendly, like a more risk aware, a more more, because the concept that we have is not to hoard wealth. So if I cannot hoard wealth, what should I do with my wealth? Imagine there is no riba. Imagine there is no way to earn money out of money. What would I do? I would, of course, put my money into investment. This is what the companions for Prophet Sallallahu Alaihi Wasallam used to do as well. They used to money to trade. They put money in agriculture. They put money, if there is even excess of money, they would do waqaf, they would do sadaqah. There wasn't any concept like hoarding money like the way we do in our banks. So I would appeal and request everyone, let's start at least in limited scale, maybe in our friends or families, those contracts, and get used to it, so that inshallah within a decade or so, our generation, next generation, they are more aware of such valuable contracts that are available in Islamic finance. And inshallah, with that, we will be inshallah also be able to gain the true fruits of Islamic finance. So with that, I will end the session today, inshallah. Thank you so much for joining again. This session is brought to you by Ethis. Please make time to visit our platform, ethis.co, as well as our charity crowdfunding platform, globalsadaqah.com. We are having some wonderful charity campaigns before this Ramadan. May Allah subhanahu wa ta'ala guide us so that we can prepare for the Ramadan and make the best use of it. Jazakumullah khairan. Assalamu alaikum wa rahmatullahi wa barakatuh.